Welcome to the True Wealth Investors Real Estate Podcast. Creative investing strategies to help you build true wealth. I'm your host, Chad Harris. Okay, gang. So what we are seeing in the current market, as Jeff said, and I said, there's a lot of activity going on in the investor space, and I think it's kind of an interesting time where the market is shifting and changing. And even though we have been in a seller's market for a lot of years, or it feels like a lot of years, the sellers had the upper hand and it was hard to find deals. Last year, we started shifting into a more stable, balanced market. And I think we're still trending. We're still in a balanced market from what I see. Sham, you can add your input too, but it seems like we're trending towards a buyer's market. Um, what do you think?
Right now, it's a balanced market, but it might trend more towards the buyer's market later this year.
Yeah, I think we're still balanced, but I think we're
Yeah,
heading that way. Like days
yeah,
on market are trending up,
yeah,
um, inventory's trending up. So
yeah.
if we continue on this trajectory, that's where we're heading. All right. But either way, where we are now, a balanced market, and all of those things working in the favor of the buyer, right? Some other things we're seeing with prices stabilizing, and this in Dayton, prices are still rising, but with the market stabilizing, there's a little more risk on the flip side, on in the flipping market. So if we're doing flip deals and we're banking on a high resale price, with the market being stable, potentially trending towards a buyer's market, that adds more risk in flipping, okay, inherently. So, and we're seeing that not only from flippers who are doing less deals or are more nervous and conservative with their numbers in their deals on the front end when they're buying, but also on the lending side. So for lenders, the lenders that I know are being more conservative with their numbers um, because there is more uncertainty in the market. And I know there are some large lenders who have had massive losses and even shut down recently with changes. So I know that there's just more uncertainty in that future on the flipping side because your numbers are only all of your profit has to be made in that 6 months or 8 months or 9 months that you own that property, right? It's in the rental market's a little more forgiving. So if you're planning to get your money back in 2 years, 3 years, and something goes wrong with the rehab or the refinance, it just takes you a little bit longer to get your money back. That's a much different scenario than a flip project where when that sells, you have either made money or lost money, and you're either making a profit or bringing money to the table to pay off your lenders. So, with the changes in the flipping market, and I think some kind of inherent things with the way the market's going, wholesalers are struggling right now. And a part of that, I think, is so when I got into real estate, for people who have been in real estate a while, and probably plenty of people have been in real estate longer than me. Um, but 2013 through, I mean, at least 2015, sellers still had a belief that their house wasn't worth much. Okay, because it's like sellers' perspectives drag behind the actual market. So as the real estate market was rising, sellers still believed their house couldn't sell, and so you could get great deals because they didn't necessarily believe their house was worth as much as it truly was. Right now, it's kind of the reverse. So sellers still believe that it's a seller's market and prices are high and they can get whatever they want for their house, even though the market is slowing down and stabilizing and that's not necessarily true anymore. So all of that means that that takes a little more work on the purchase side and on the negotiation side with the purchase. All right. So those are some things we're seeing, and you guys can throw questions into the chat if you want. It's a small group. If you want to raise your hand, ask a question, shoot. The whole purpose here is for everybody's benefit and just to have a discussion. Some other things we're seeing on the rental side, tenant applications are slowing down. So rentals are sitting on market longer. Some of that is the time of year, but it's also, I mean, it started before Thanksgiving, and it is also just slower because the market is slowing down. And the applications that landlords are getting are worse than they were previously. So you're just getting rough applicants. All right. And if you are a landlord and you do have properties for rent, this is a good reminder that a bad tenant is way worse than no tenant. So keep the faith, don't lower your standards. Keep looking for that good tenant, and it's much better to let the property sit and wait for the good tenant than to rent to the wrong tenant, and suddenly you have unpaid rent, you have damage to the property, you have legal fees, and you still have vacancy and turnover to actually get your good tenant in. All right, so
Hey,
just a good reminder
Chad,
there. Go ahead, Sean.
Ben,
Oh, yeah.
is it okay to just jump in with questions? I don't know.
Jump in. Yeah, no worries. What do you got?
Yeah, you were saying a good renter, and I was wondering, we're all kind of focused, concentrated on Dayton here. Obviously, there's several different neighborhoods to the Dayton market, but do you have metrics for like what is a good renter for different regions or areas of Dayton?
Well, I don't have metrics as the like what is defining a good tenant per different regions of Dayton. I don't know that it necessarily even changes per region of Dayton.
Nope.
You know, there are um, some neighborhoods that you would deem more desirable and some neighborhoods that are less desirable. But in my experience, people want to live in certain areas of town, and there are tenants with great credit and great work history in every area of town. So if you go to our website, arrivaloh.com, you can see some listed properties and our requirements for a tenant applying are on there. And we use those requirements no matter what the neighborhood is. So if
Well,
that makes
I just want to share something. Just establish some minimum standards and stick to them. Like Chad said, no tenant is better than worst tenant. The thing is, you just have to make sure if you price it right, the rental property, and you present it right, you will find a tenant, no matter what area of town it is. Because people live in certain areas for whatever reason they choose. Sometimes they grow up in the area, sometimes they go to school there, or they go to church there, or their families live there, friends
Yeah.
live there. It doesn't matter. It's their choice. Our job is to present a product and have them choose, make sure they meet the standards that you established and never deviate from your standards. That's all.
Yep, perfect. I agree completely. So I'm not a realtor, so I can say if a zip code is, let's say more desirable or less desirable, and I can say in
Because yeah,
45322, very good zip code. We have had some terrible applicants with terrible credit that I would never rent to. And 45417, we've had some great applicants and great tenants, and that's true for any zip code or area. Good question though. Appreciate it. Did we answer it
yep.
all right for you? Was there a follow-up?
Um, do you guys have, um, could you share like what you guys use, what your standards are for screening renters?
Yeah, if like I said, if you go to my management company's website and look at the listing, our criteria is in every listing so that every applicant can see it before they apply and
Gotcha. Thank
they
you.
self self-screen before they spend money on the application fee. So yeah, check that out. Good
Hey, Chad, I
question.
got a question for you.
Yeah, go ahead, Jeff.
Um, the data that you had that you said about rental times or the amount of time that unit is open has increased. Where are you getting that data? Is that MLS data or where are you getting that?
Oh, the amount of time that it takes to rent a unit.
Yes.
That is, I did not get that from MLS. That's from our company, friends, coaching clients. Everybody's just saying similar things that it's,
Okay.
um,
Yeah, because I don't agree, because especially this time of year, it's tough to rent out a unit. But I was just curious if there's somewhere where you got that data, because I'd be interested in reading more about it.
yeah, yeah, no, that's that. Now I can't remember the exact word to describe that, but that is from experience and conversations. That's not from any data source.
Okay.
So,
All right. Thank you.
yeah, good question. All right, so yeah, and feel free to jump in or throw it in the chat. Okay, so what we're seeing is buy and hold market is moving. Like I said before, investors are active. They're starting to see more opportunities, and there really are more deals. Um, Realtors are busier, title companies are busier, right? In the investing space, everything is picking up. And if you are wholesaling or doing marketing, I would suggest you market for properties that are your end buyer is going to be a buy and hold investor. Those are the active buyers. Flippers, a lot of flippers have slowed down or just gotten more conservative and more tentative. If you are marketing, I would suggest marketing to landlords. Currently, landlords are having tenants who are paying later, right? This is from experience. This isn't data, Jeff, but we're seeing tenants, more late pays from our company clients and friends. And so, current landlords are frustrated with their current tenants. They're having more evictions or more late pays. And there's just inherently always landlords ready to retire, right? It doesn't matter what the market is, you will always have uh, property owners who are phasing out of their career or business. So that's a good opportunity right now. With landlords, it's a really good opportunity to make seller financed offers. Um, Landlords have been getting monthly checks and living off those checks. They like getting paid monthly. They don't necessarily want to pay capital gains, and they also have probably put their blood, sweat, and tears into that property and don't want to sell at a really low price. So all of that lends itself towards seller financing. If it's occupied, that's also beneficial for us as buyers because we can get the deposits and prorated rent at closing, and it helps with the cost of closing. The two houses we bought this last week were both occupied, were both in great condition, and so it was very easy. One of them that I'll talk about tonight included some seller financing. If you're making offers on the MLS, we're seeing a lot of good deals coming through MLS. Not necessarily good deals when they're listed, but if you consistently run numbers and make your offers based on the ARV and not the list price, because the market is trending balanced, trending towards buyers. There are a lot more deals coming from the MLS. I think it was 2 meetings ago. This really sharp young investor named Elias Harris shared on this program how to run numbers, how to make offers, and based on the ARV, that recording is on the website gdred.com. Or if you email me, I'll send you a copy of the recording too, if you want that information. If you're looking for my email, it's on the bottom of my picture there by my name. All right. Okay. Now, in addition, and I know this isn't like a real organized presentation. I'm just sharing what we're seeing in the different indicators in the market, what opportunities we see. So in addition to that, the stock market is currently high. Okay, so the Dow Jones is at 49,000, has been showing great returns. And at the same time, interest rates are fairly high, still 6 to 8%. Investor rates are more like 7 to 8%. So what that means is that private money is very attractive to raise private money because our ideal lender, at least the ideal lender from my perspective, is somebody who has money in the stock market, other investments. And so when the stock market is high, they are looking for a reason to pull some of those profits out and put it into something else. And especially the older they get, they don't want to have a drop in the market and wait 10 years for it to come back, right? So right now is a really good opportunity to present to them the chance to be a lender in our business so that they can pull some of that money out of the stock market, um, collect some of those earnings, some of that equity that they have built up in their portfolio. So that's a good opportunity. And then with interest rates, the what we pay our private lenders isn't tied to interest rates, but because interest rates are higher on the long term, that means we can usually beat that. So 7 or 8% will pay that to a private lender. Private lenders typically will go to 6% very easily long term. All right. Let's see what else. Seller financing is still a great opportunity, and we're focusing us in our business. We're focusing a lot of our offers on seller financing. So underlying financing with a lot of sellers is still in the 4 to 5% range or lower because they purchased or refinanced before rates rose, which is very good. Seller financing gives us a lot more freedom in our offer. So a lot of people are complaining if we talk to um, investors, and maybe you've heard this, right? They're saying, well, prices have gone up. So how can I make money? How can I have a rental that cash flows when I'm paying this high price? Okay. And the solution to that, a lot of them are saying, well, I need to wait till interest rates drop, then my financing payment will drop and it'll suddenly cash flow. Waiting is not a good game, right? Waiting is not really a winning strategy for success or investing or anything else. So seller financing is a solution to that. So we can structure the deal super creatively so that that high priced rental suddenly will still cash flow at the high price. All right, and we'll talk through just a couple simple deal structures. Let's see here. All right, so three creative deal structures with seller financing. Number one, and these are in no specific order, just some things we're using. Number one is with seller financing, you can offer if they want a higher, so typically, when we're making offers, we're looking at purchase price plus rehab. Okay. And that number, we want to be at 70% or less of the ARV. Now, if a seller wants above that 70%, we've had success making offers where we will go above 70%, but the down payment, or we will give ourselves credit for a down payment that is actually money in the repairs. So, for a ballpark example here, let's say we have a rental and we agree on a price of 100,000. That's what our max offer is. Um, and they want, let's say we figure there's going to be a $20,000 rehab. All right. So we are making our offer $100,000 purchase price. We're planning for a $20,000 rehab. The seller comes back and says, no, I need 120,000 for the house. And so then we will alter our offer to say we will pay $120,000 for the house, but $20,000, there's going to be a $20,000 credit for a new roof and let's say furnace or furnace and flooring, furnace and windows, something like that. Okay. And so for us, what we're paying for the house is still 120. For the seller, the price on the contract, which is what they really care about, is 120. So we both win in that aspect. And in for them, they're not truly receiving that 20,000 unless we default. But the security for their loan is actually better because we're making improvements to the property and including that in the contract. So that's one kind of creative way to get around those negotiations where they're not necessarily willing to go for the really low price. All right, another creative way is, and I like this one, is to create two notes. Okay, and in this strategy, let's say we have a house and we'll say same thing. The purchase price is going to be 120 and it won't cash flow at 120, but it would cash flow with a amortized payment based on 100. All right. So for that to work, we'll create two notes. The first mortgage for that seller will be $100,000 and it'll have an amortized payment. The second note would be $20,000 and that would have no payment for a, a period of time until we're going to refinance. So in that way, when we create two notes, but only one has a payment, then they get their sale price that they want, and we get the payment that we want. And so as long as that price still works for us, that's a good way to have a property cash flow, even though we're paying more than it. We're paying a price high enough that it wouldn't cash flow. That works really well if maybe it's an occupied property and the rent is low, which you'll see a lot when landlords are selling occupied properties. The rent is below market. They haven't raised the rent in a long time. There's no way to have it cash flow at the current value or current sale price. And so by creating two notes, you can cash flow at the low rent that it's currently at, raise the rent over time, and before you have the balloon or the change in your payment where your payment starts on that second note. All right. So that's another one. Um, I like your comment there, John. Yeah, a lot of deals coming from the MLS today. So it's interesting. It's I like it. It's a good thing. And the deals are always there, but there are definitely more now. So yeah, similar to what you said. All right, number three. And you guys chime in if you got a question. So the third one, and I'm going to try something new out tonight. I wanted to let's try something just for fun here. You guys tell me if it's beneficial or not. All right. We are going to try a whiteboard, which I've never done on one of these Buying Without Bank Zoom meetings, but we'll try one out. So if you look at the whiteboard here, all right, so the third type of deal is third type of deal. Can everybody still see my screen?
Yep.
Holler if you can't. All right, everybody's with me.
Yeah.
And Ben, I will answer that definitely. Um, Okay, so this is a picture of one of the houses we bought last week, and this is in 45426. All right, so it's in the Trotwood area, and this is an occupied property. The ARV is around 140. We'll throw some data in here. Let's see. All right. Okay, so the ARV 140. The purchase price, the asking price from the seller was 95,000. Okay, so the property fixed up's worth 140. The purchase price would be 95,000 or the asking price. And it doesn't look super fancy from the outside, but it's low maintenance. There's really not any issues with it. And on the inside, it was really renovated nicely. Um, and the tenant takes great care of it. So, looked like a great deal to us. We agreed with the purchase price, but we were going to use private money, and the we didn't have 95,000. I was busy with other deals and everything else going on. So I offered him, "Hey, would you take 50,000 down and a note for the other 45?" Okay. Since we had access to the 50, and so that was our offer. He said, "Yes, that's great." All right. So we put cash from a private lender of 50,000 and then a note, and it's not that long a note, 7-month note for 45,000. So the benefit to that is that we can use the money from a private lender, right? The private lender had 50,000. Today's market, you're going to buy a house generally for 50,000 that needs a lot of work. And so we could use the money from the private lender to purchase the property. The property will cash flow very well, obviously, for the 6 months until we refinance. And then, according to the seller finance note, we have 7 months to either do the BRRRR strategy where we refinance with a bank long term or raise the rest from a private lender and pay off that note. All right. So let's see, those are the numbers there. And so that means we got, what do we got here? Ooh. So we created 45,000 in equity. I like equity. Um, Equity is truly, in my mind, is what leads to wealth, changes your life. And so we created 45,000 in equity. And then as far as the amount of money we used, if you remember my one rental to freedom presentation, right? The money that we needed for the deal, how much money did we need to buy this rental? So we had zero cash in the deal, which I liked, right? That's always our goal is to not have any of our own money in the deal. And obviously flows very well because it's already occupied long-term tenant and inexpensive financing at 6% from a lender. All right. Any questions on this deal or the three seller finance strategies I talked about there? What do you have any questions on that before we dive into the private money lending side? And the recording from this, Ben, will definitely be available through GD RIA. Either I or Shay, usually my assistant sends it to Kimberly, and it'll get on the website. Anything from anybody? Any questions? Any comments?
Yeah, for the 50K cash, whose cash was that?
Yeah, that was from a private lender. So they were given a first mortgage on the property. The seller was given a second mortgage on the property.
Gotcha, thanks.
Yeah, of course. All right. What do you guys think of the whiteboard? Do you kind of like the visual, or
Yes,
is it beneficial?
Yeah, I
Yeah, I
like it.
like it.
it is. Mm-hmm.
All right,
It's
cool.
it's a little smaller. The numbers are.
Mm.
Numbers are too small.
Yeah, a little smaller. For me anyway.
Oh yeah, the tiny. Oh yeah.
All right, I'll work on it. I'll improve my whiteboard skills. But hey, I thought I'd try it out. Man, someday we'll look back on this sad attempt. We'll say, "Oh man, I remember him back when, before he was a whiteboard expert." Maybe we'll see. All right, nice. I like it, Kimberly. Thanks. Okay. Any other questions? I'll go ahead and unshare here and you can ask your questions. We'll dive into private money lenders. Um, all right, so there's multiple kinds of private money lenders, Ben, related to your question. And so we have some private money lenders right on the call and they have their terms and I don't know. I mean, I know John and I know he's very professional, but we haven't ever talked about what his rates are or drawing a blank. Oh, David as well. Um, so you can talk to them there about what their rates are, how they lend on deals, and how that works. And you can also, there's generally when I talk about private lenders, I'm talking about raising money from an everyday private lender who isn't necessarily in the real estate space, but they're in stocks, mutual funds, other things, and we present the opportunity for them to be the lender in our deal. So, and there is no one right funding solution, right? Any funding is good. Any way into the deal is better than not getting into the deal. So, I'm all for you using whatever strategy works best for you. Hopefully that answers your question. How to find private money lenders, um, so that you can be on this call. You can text John or comment to John or whatever. He's got his number on there. You can text him. You can talk to private money lenders from GD RIA. If you're looking for everyday private lenders like I'm talking about who aren't in the real estate space, then that takes a little more work. There's three primary ways. One is introducing yourself in a way so that people know they can be a lender in your business. So you want to share why you do, what you do, and how they can play a part. That's one way. Two, setting up meetings, just working your contact list in your phone, right? Probably hundreds of contacts in there, working that list and setting up meetings with people, letting them know how they can be a lender in your business. Or three is leveraging social media. And if you want to do that, you have to make sure you don't ask for money on social media, but you can do a post where your lenders are the hero, right? We're buying this property, it's very profitable, our lender is making a great return, and um, it's secured by real estate, something like that. That's not the best example, but it's a simple example of how you're reporting what you're doing in your business, but the lender is the hero of the story. So anybody who reads that post should relate to the lender and want to be in the shoes of the lender. Okay. But like I said, all of those take more effort, right, to educate that everyday private lender on how they can lend in your business. And then people in the real estate space, that's why they're in the real estate space, is to lend in deals. They understand how to vet deals and borrowers. And so there's less effort in that space. I hope that answers your question, Ben. Feel free to follow up. Or John or David, feel free to jump in if you have anything to add with how to work with a lender.
I had a question, Chad, on your when you're doing like a second.
Yeah.
Um, is that are you doing that through a title company and is that recorded or how exactly are you structuring that?
Yeah, we close with a title company, and yeah, all
Okay.
our mortgages are
All
recorded with the county.
right.
Yep.
Excellent. Thank you.
Yeah, great question. Yeah, that especially well working with sellers or lenders, right? That lends credibility and shows that you're professional and it's above board and it's not a handshake deal or anything like that. So
All right.
good. Appreciate the question. Anything else? All right.
Pat, I have a question.
Yeah.
More like, I don't know, it's a concern. I mean, I heard about 2008, 2005, like market being crashed or something like that. I was in high school, so I don't know. But is that the same thing that is happening now, do you think? Is it still a good idea to buy and hold? Because, it's my first time like experiencing this. Some people are saying, oh, do not buy a house right now. The economy is bad. And then some people say, oh, it's a good market. So I'm torn, So
Yeah.
I don't want to get discouraged, like quit. I'm not going to quit, but you know what I mean? It's a little bit,
Yeah. Anytime you're doing something different from the norm, right? The rest of the flock is going to be telling you that you're not smart in what you're doing. As long as you're doing something different, if the whole flock is running this way and you're running this way, they're going to try to get you to turn and run with them, right? That's the analogy I use, and that's okay. That's all right. Just need to have confidence in what we're doing. And earlier in my career, I would try to convince them, no, no, this is a good opportunity. Come on, you should be over here. And I gave up on that long ago, right? They're going to do what they want to do, and I'm going to do what I need to do. And so for you, I would have confidence that we are not heading into another 2008. 2008, not that I'm an expert, but it was a unique situation where it wasn't just the economy slowing down, but it was more an issue of the lending practices and financial um, things where they structured bad debt and then renamed it as good debt. And so it kind of created a false platform. And once that collapsed, then you had a whole bunch of things, consequences that came with that. So that's totally different than the normal economic cycle where the economy grows, there's growth, there's inflation, then they raise interest rates, the economy slows down a little bit, and then it grows again. That's the normal economic cycle. And then maybe once a generation or more, probably more than that, because you had the depression in what, 29, and then the recession in '08. That's a 90-year event. Okay. So, or
Hey,
80
Chad,
year,
I want to share something.
Sean. Yeah.
One of the big differences between 2008 and what's happening now, we're nowhere close to 2008, 2007. I don't think we're going to ever get there. Here's what I think. I know that in 2007 and 8, people pulled most of their equities out of the property. And then what they owed to the bank, the property was not worth it because they were underwater to begin with. I've seen several investors from GDRIA, they didn't listen not to pull everything out of it. When the values dropped 20%, they had no equity. The only way they could sell the property, get out underneath because rental was tough, selling market was not there. So they ended up pretty much doing a short sale to avoid a foreclosure. That was the theme. I've done about couple of hundred short sales at that time. I was teaching realtors how to do short sales at that time, state approved license certification courses. So we're not going to get there because that was a big difference. People didn't have any equity in the properties. No, at least now, because of the all the price surges and everything else, people have equities in the property. I hope they don't make the same mistake again, but pulling most of their money out of it. My goal is tell them leave at least 25% in there.
Good.
That's it.
Yeah. 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 Equity is good. Right. Yeah, I agree. There were a whole bunch of things that kind of um, led towards the Great Recession. You had loans that were interest only for a period and then would start amortized so people could afford the payment when they got the loan. And if they didn't refinance or sell the property, then when the payment switched to amortized, they couldn't afford it. Those products were fine and dandy when prices were just kept going up and you could constantly refinance or sell the property. But then as soon as the market slowed and people couldn't sell their property, obviously that's a problem. There were just a whole bunch of things that led to it.
Right.
But in our economy currently, so we don't have high inventory in the housing market. We don't have, I think, lending. There's not what before '08 lending was there were very few restrictions.
Yep.
Um, just about anybody could qualify for a bank loan. So landlords renting had a hard time because the just about any tenant that they would normally rent to could qualify to purchase a house. So the renting pool was much lower. We don't have that today.
And the
Right.
banks were lending 100% for investment properties. They made two loans, 80%, 20%. That's how Liberty Savings went under because most of the investors couldn't afford or couldn't sell. So Liberty took the bath on it. And that's when the whole banking regulations changed, where now they want at least 20, 25% down, a big credit score, a lot of money down. It's
Yeah,
just a bunch of reserves. So they're asking for a lot of stuff.
right. Good. We don't have high unemployment. So in my mind, everything looks good for the economy.
Yeah.
It's just a natural slowdown. And I think with inflation, a lot of people have tight budgets, and that's more what we're seeing on, late pays or tenants not wanting to move. It's more just that their budgets are tight. It's not that there's some major issue with the economy. So, all right, good stuff. Okay. Were there any other questions? Looks like we're a little after 8 tonight. I'm open for anything. I appreciate you guys hopping on. What do you got? Ben, let's see, who are the two private money lenders on here? Um, in the
David.
comments there, you can see John Hayes is a private lender. He's got his phone number there.
Yeah.
David, I know you lend. If I don't know exactly what kind of products or anything you offer, but David Frazier would be the other one.
I don't actually lend, Chad.
Oh,
I'm more of
okay.
a private, I utilize private money the same way you would. You utilize private money to purchase a house. I utilize private money to purchase the mortgage attached to that house.
Okay. Note buyer.
No
Sure.
buyer.
Okay.
Yes, sir.
Gotcha. I'm with you now. Okay. All right. Good stuff. Is there anything you guys are seeing in the market that we haven't talked about? We'll do a little wisdom of the collective. Is there anything you guys are seeing or wondering about? John, with borrowers, are you seeing anybody struggling with the resale value of their flip deals, or are you having any uptick in your clients?
Yeah, the flip game, a lot of the guys that are were in that for a living, they went and got jobs. I mean, broadly speaking, there's a lot of them that have been kind of really exited last year, midstream even. We've never really, we'll fund flips all day long. We'll fund new construction. We'll fund anything that makes sense. We like to um, second position loans that we took a bath on back in aftermath of 2008. So we've been there, so we stay in first position is what I'm getting at there. That said, I mean, and I only say this for purposes of shortcutting the conversation, we're the largest private lender in the state of Kentucky. Whoop-de-doo. We're just a family office, so we don't have any kind of sales force. We're not really what anybody else would maybe paint the picture of us as being if we're explaining ourselves. We're investors first. We understand how to lay this money out. Where I say this about the private side, this is my general take on utilization of private money. The deal, in my opinion, is never going to be in the pricing. The deal is going to be in the structure. Absolutely. If you can get some private guy to go out here and give you a loan for 5 years, sure, I'll take it. You'll take it. Anybody will take it. You want to give me 6, 7% for 5, 6, 7 years? I'll take all that money under the sun. I'll borrow that today. We make our money on the churn. So we look at it like this: a rate and term, no cash out refinance is the cheapest refinance that you can do. All right. A cash out refinance. See, we do 30-year fixed mortgages as well, right? A cash out refinance in an unseasoned amount of time through DSCR is more expensive than a rate and term, no cash out. All right. And you can do it in an unseasoned amount of time. So what does that mean? I use the private money this way. That house that Chad showed earlier is a primo example to the question of what somebody asked earlier, like, what would you suggest right now? Exactly that type of house is what I would suggest. Because if that house right there is not able to be rented out, the world's ending. Like literally, the world is on fire. That is the baseline of America. That brick box that's not huge, anyone on here can rehab that house. Guys get carried away and go do big projects. That is an easy project to do. I can teach a 15-year-old how to do that project right there, 100%. That's exactly the type of properties that I like buying. I like funding those type of properties. Now I lay it out like this. If I give you 100% of the purchase and I give you 100% of the rehab and I give you no prepayment penalty and any fees that are going to be associated with that loan, I roll into the construction budget. Now think about this, Chad, because you've utilized the private money plenty, but think of it just like this. Let's say for easy math, we've got an $80,000 purchase on a little 2-bed, 1-bath Cracker Jack box with a great foundation and it's brick. It's going to rent for $12.95, $12.50, because we're going to make it look like an IKEA dollhouse. That little house at an $80,000 purchase, all right, and let's say a $24,000 rehab for easy math. That's a $104,000 recorded note. All right. The DSCR, or the rate and term refinance, where we do not cash out, looks like this. The rate and term looks like this. We are going to give you 80% of a new appraisal, not to exceed what is in the note, meaning no cash out, in an unseasoned amount of time, no prepayment penalty on your short-term capital. Boom, you have now bought a house with using none of your money. The house that I would describe appraises at 155. The DSCR ratio is there. All right. You can borrow 80%, that's 124, but you only owe 104. So you used zero of your capital. When you come to the table with me, I am allowing you to come to the table with nothing but a paid for insurance policy, and that's it, with no prepayment penalty. Chad, I got a flooring contractor that bought 23 houses last year, and he just started. We're not hocus pocusing. We're not doing anything stupid. He's buying small, simple, good foundation properties. And man, we're turning these houses so fast, it's ridiculous. And I'm going to the neighborhoods where I always describe them as this. They look like that little brick box that you threw on. We will be brand new everything on a house like that in less than 2 months. There's just nothing there. Speed is everything. With the utilization of private capital, speed is everything. So me as the borrower of this money, these are non-negotiables for me. I want 100% of everything. I want no prepayment penalty. I do not want to have to fleece my previously owned properties. I do not want to have partners, and I don't want to use my cash. So I don't really care if you're going to give me that money at 7%. If a dude down the street is going to give it to me at the terms that I'm suggesting at 12 and 13 and 15, 20, I'll go take that with no prepayment penalty, because I will be so far down the road with rate and term refinances that all I got to do is just crank that private money quickly and it's game on. So like I just wrapped up 17 of those myself. I'm doing multifamilies this way. I'm doing single families this way. I don't touch my cash, and I build my portfolio just like this. And that's why in Kentucky, where we are validated, that is why we are more than double the size of the next biggest outfit to us, because we are genuinely showing people how to build portfolios. Flipping's cool, but that's a business. That's a job. If you want a job, everybody should have a job, but that's a job. It's a high taxed job. Well, I get taxed on lending money, right? And I go buy real estate to offset that money. So buying and holding real estate's where the gold is. I don't care what anybody else says. We can get as creative as we want. Buying and holding real estate is where the absolute gold is, and the utilization of private money is absolutely key because what Sham said earlier, and I use those loans. 80/20 loans don't exist anymore. And I used to do exactly that with the banks. After 2008, that's when we went to this version of borrowing money. Before 2008, I borrowed money exactly what Sham was talking about earlier, and I bought turnkey properties. All of my really nice properties were bought back then, and they were done with the exact 80/20 that Sham's talking about. It doesn't exist anymore because I wasn't making no money back then. My credit was fine, and they were just giving me money like crazy. Now I gotta be, I gotta have a little bit of, you know, credit, so to speak. So I'm preaching, but utilization of private money is a big, big deal.
Yeah, man. I'm glad you said you were preaching because I almost let out an amen there a couple of times while you were talking.
Tell them they never believed my granddad was a Southern Baptist preacher in the hills of Southeast Kentucky, baby. I have a
Yes,
problem
John.
running my mouth, but I'm telling y'all, man, I'm passionate about this because there's so much noise in the real estate space. And what I just now described, that's what for real can take someone from, hey, I got nothing out here in this real estate game. And you can get so confused with so much out here. And what Chad just laid out, like I said, with that one house, that is the game. You can't mess that up. I don't care what's going on out here in the economy. If that house won't rent, the world's on fire. So if I'm going to go down in flames, what difference does it make if I have real estate or if I don't? We started buying and holding right at the Korean War. Every single thing that we've been involved in, I've watched go up, down, up, down. You know what's never went up, down? Them little Cracker Jack boxes. Them
Mm,
things have worked every single time. They've never not worked. You just got to buy them right. You can't crazy overpay, but you can almost a little bit overpay. And I buy them right off the MLS, left and right.
it's awesome. Sure. I like it. Tawny, you had a question, a clap. I liked it all. Did you have something you wanted to add or something you wanted to ask?
I gotta figure out how to unmute myself. No, I really enjoyed listening to John. We're doing the same thing. We're buying the ranch style slab houses, 2 months rehab, refinancing, cashing out. We're doing the same thing. I mean, we've been doing that hardcore and it's been working. And we fix them up so nice that the lender says it's worth more than even me as a realtor could even comp them for. So I mean, even by 10 grand. So yeah, even my insurance guys like, Tony, we gotta charge you more because you did so good. Not that I outdid the property, not that we outdid the neighborhood or anything, but it's just that nice. I mean, it's always going to rent, and we keep up on them too. You know, we just did a quarterly inspection today. So, John, I really appreciate you talking, and I could definitely listen to that because that's my vibe. So, thank you for sharing.
Yeah, awesome. Sure.
Hey, Chad, before you wrap it up, I'd like to make a little announcement about the third Wednesday meeting, two
Yeah,
days from now. Yeah.
go for it. Were there any, before Sean makes an announcement, any final questions, comments, anything else? All right. Well, I appreciate everybody hopping on. Sean, go ahead and make an announcement for the third Wednesday meeting.
Thank you, Chad.
Yeah, good seeing everybody.
All right. Next 2 days from now, not tomorrow, but day after tomorrow, 5:30 p.m. at the same location we have a general meeting. We have our third Wednesday meeting. And this month, we're going to do the topic that we're supposed to do in December. But since we didn't have the facility, we're going to move it to January, which is setting goals and drawing up action plans. Why is it necessary for a successful year? Plus, there's a good chunk of that has to do with time management skills. So just come on over. I'll have a handout. It's going to be a 1 hour presentation. You'll have plenty time to ask questions, and you have time to do some networking also. That's all.
All right. Sure. So everybody check that out. Buying Without Banks will be on again in March. And there's a lot of meetings going on in between that. So definitely go to gdria.com, check out the calendar there. Otherwise, we'll see you at a live meeting or online soon. Appreciate you all and have a good evening. I have a really good gift for you to help you out. So, in recent episodes, we've talked about some really great partnerships we have that will help any of you get motivated seller leads, right? So, you'll get a text when they get the lead and they'll just give that lead to you. Or we have a direct mail partner who will help with direct mail to make sure you can reach the people that you want and get those leads contacting you. Okay, great services, don't cost any extra. Just make sure that your marketing is impactful and you get a return on your money. All right. So the gift isn't related to those. The gift is that some people are kind of nervous by the idea, those services are great, but now I get a seller on the phone and what do I do? What do I say? Right? And it's kind of intimidating. Everybody, when they get started, feels a little intimidated or nervous by it. And really, you just need a script so that you know what things to talk about with the seller on the phone. You don't have to think about it. You just follow the script, have a human conversation with the seller, take an interest in them, and follow the script. Just that easy. All right. And so the benefits of the script are you don't get distracted in the conversation. You can just follow the progression of that script, makes it super easy, can give you confidence so that you know what to say when, and it actually helps that seller know that you're professional and serious and you know what you're talking about. All right. So you can get that script at truewealthinvestors.com/call script. And that will give you the free download so you can have that script. Then when that seller calls, you know exactly what to say. All right. I hope that helps, and I know it will. See you soon. We are adding new episodes every week, so make sure and subscribe and check out all of our content at truewealthinvestors.com.